Hi, guys. We are having a hangover after 13 years of ultra low interest rates. 13 years when companies that had minimal cash flows saw their stock prices go to the moon. 13 years when investors having minimal investing knowledge and poor temperaments saw their returns go up and up and up. That time is over. Cash flow is sexy again. Value is the new cool. Nothing wrong with that in my view. But my guest today is Brian Feroldi. He has made a lot of money over those 13 years. He's down a bit like a lot of people lately, and he has a newfound love of valuation. I respect him for that very much. He cautions you, though, don't use the PE ratio and be really, really careful if you even think about using discounted cash flow valuation modeling. If anything in what I've said rings true to you, matches your story, you're going to like my interview with Brian Feroldi coming up. My guest today may have the best smile in all of investing. Now, more seriously, if you took a typical tech-loving millennial and merged him with a classically trained investment analyst, accounting and valuation knowledge, and then added someone who is a phenomenal teacher with a true love for teaching, you would have Brian, it's a lot of embryos, by the way, but you would have Brian Feroldi, my guest today. He describes himself as a financial educator. He is definitely that. He is more. He is author of Why Does the Stock Market Go Up?, which is a great book, by the way, for everybody, but also for young people, because he's got a lot of these short, digestible lessons that you can read in several in one sitting. He's also a popular YouTuber. He's got a very popular Twitter account, a lot more followers than I have, and probably Instagram and others. I'm not a big Instagram guy, but I'm guessing, Brian, you have that. So, Brian, welcome, and thanks for joining me today.
Yeah, thanks so much, James. Super appreciate that. As you know, I've been hearing your voice in my earphones for about 14 years now. So it's awesome to be a guest.
That's too long to hear James Early, but I appreciate that. Appreciate that.
No such thing as too much James Early, in my opinion.
I wish everybody felt that way. So Brian, we've had, since we last spoke, you're great at connecting what's going on with the timeless investing lessons underpinning them. And of course, there's a challenge, right? Because sometimes what's going on feels very strongly this way or feels very strongly this way. And the timeless investing lesson may be contrary to that. Sometimes it is parallel to whatever's going on, if that makes sense. So let me segue that abstract point into a more tangible question, which is, if I recall last time we spoke, your portfolio, which has a lot of tech stocks, was down a bit because tech stocks were down a bit. Interest rates have gone up even more since then, thus really ending 13 years of really, really abnormally low interest rates. Question, how are you doing these days? And what do you think the main lessons investors should be taking away or applying to looking forward are?
I wish my portfolio was down just a bit, as you just mentioned. It was down substantially more than that. My personal portfolio, as you mentioned, which has skewed towards growth stocks, really peaked in value in 2021, and it's been a sickening slide ever since. We've had a big relief rally in the first quarter of 2023, but who knows if that's going to last. But to your point, I've been investing for almost 20 years now, and I would say that the last 3 have been the weirdest that I've seen over that time period. I mean, just to review, if you consider 2019 to be a quote unquote normal year, whatever that is, it wasn't, but you consider that
at least it was pre-COVID,
normal times, right? Yeah, pre-COVID, right? We saw a COVID happen. The world got flipped upside down. Money poured into the markets. All these tech stocks took off. The crappier the business, the better the stock did for a short period of time. That brought in tens of millions, literally tens of millions of brand new investors for the first time. You had meme stocks going crazy. You had SPACs going crazy. Growth stocks going crazy. Losing money was absolutely okay. And then over the last 18 months, we've seen the exact reversal of all of that situation. And when you combine that with, to your point, the fact that you layer in 13 years of essentially 0% interest rates on top of that, it's been incredibly trying times for investors. Personally, I started investing in 2004, which was, again, a quote-unquote normal time for the markets. And the first big lesson that I learned was from the 2008 financial crisis, which was when everything went down, and it seemed like we were entering the Great Depression. In response to that, interest rates fell to 0%. And that was during a time period where I really learned and leaned into investing in a strong way. One thing that investors have had to learn over that period of 0% interest rates was really to focus on growth. Growth was the thing that the market prioritized above all. And not only growth, but the key lesson that investors that did the best had to learn was de-emphasize valuation, right? But we just saw multiples expand for essentially a 13-year period, which makes complete sense in a zero interest rates world. There was nowhere else that an investor could go to get a return beyond the stock market. That forced billions, perhaps even trillions of dollars to flow into the stock markets, which continually pumped up valuation. And when you combine that with record low in inflation, it was completely acceptable to buy these companies that were going to pay off 5, 10, 20 years from now. So the key lesson that I had to learn as a natural value hound during that time period was de-emphasize valuation, something very unnatural for me to do. But that is something that I learned, and that is what worked. Over the last year, I would say, all of those key lessons that we've learned over the last 13 years have been thrown out the window. And for the first time in 15 years, valuation, to me, is something that investors should really focus on. And that is direct response to inflation and interest rates returning to more normal levels.
Well, I respect that. Not a lot of people change their minds in investing or just in life overall. And I was going to ask you, what's changed? What have you changed your mind about recently? And it sounds like valuation is the first answer off the top of your head. So I, as someone who also likes valuation, as someone who kind of grew up in the same vein you did as a value-focused analyst, and was watching what looked like the world falling apart for 13 years in the sense that all the laws of physics that we'd come to know and love were just not working. Math-wise, $1 in a year versus $1 in 10 years, you compare those two, promises or expectations. Normally, with reasonably high interest rates, $1 in 10 years is worth much, 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 much less. But when interest rates are near zero, the difference is not so great. So in other words, if you're a biotech, if you're some tech startup with cash flows way into the future, your value is not necessarily impaired as much in a low rate environment as it would be in a normal rate environment. That's why we had all these really aggressive or unusual companies going public and getting high valuations before they made any money. So that tangent aside, going back to valuation, can you take us the next step, Brian? And if someone is watching this and they say, "Hey, I'm one of these people. I'm a millennial. Maybe I'm 30 years old, and I got into investing during COVID. It was fun. Everybody was making money, and of course, everybody likes to invest when everybody's making money. And I got a Robinhood account and all that. And then my stocks went down. How do I look at valuation through Brian Feroldi's eyes?"
Yeah, valuation is one of the trickiest parts of investing in general because there's so many forces at play when it comes to valuation. To make that point home, I've seen stocks that are statistically cheap. They trade at 5, 6, 7 times earnings, and you think, "Oh my gosh, this company is a screaming bargain right now," and then that stock goes down 90%. Conversely, I've seen stocks trade at 1,000 times earnings. Their PE ratio is 1,000, and then from there, they go up 10 times in value. And if you just understand the basics of investing, the ratio that people learn about right away is the price to earnings ratio. It makes a lot of sense why the PE ratio should work. However, in practice, when you're using the PE ratio on an individual company, there are a number of forces at play that essentially render the PE ratio useless. And just within the last few years, we've actually seen new accounting rules come to market that render the PE ratio even more useless
than it was before.
In some circumstances than it was in the previous 5 years. One of the most useful things that I've discovered about valuation is really understanding the business growth cycle, the revenue and profit dynamics that a company goes through during its corporate life cycle. Quick example. If a company is founded, let's say a new company, startup is founded, and venture capitalists invest money into that business, it's very normal for that company to be focused at growth above all. The only thing they care about when a company is young and dynamic is getting the product market fit right and grabbing customers to corner a position in a market. Under that scenario, It's very common for companies to be spending far more money than they're pulling in revenue. And if you try to apply normal valuations to companies in that stage, you're going to come up with the wrong conclusion.
They'll all look overpriced, yeah.
Everything's going to look overpriced, right? There's no profits to look at. There's no cash flow to look at. So if you try and apply simple valuation metrics to companies that are in that early stage of development, you're going to come to the wrong conclusion. Over time, if that company is successful as revenue grows, hopefully the losses that company experiencing will shrink over time, and then you'll experience this magical time when the losses all of a sudden flip to profitability. And during that time period, which is a monumental achievement for that company to achieve, this is when valuations all of a sudden start to get turned on, but they're extremely confusing during this phase.
Because you could have one penny a share in EPS, right? And then you could have like a 10,000 PE just because the denominator is so small, right?
That is exact. That you nailed it right on the head. If a company reaches break even, all of a sudden it has earnings. It has an E for the first time. So the PE ratio gets turned on, and it's very common for that PE ratio to be 500, 1,000, 10, or some like ridiculous number. And if you just looked at that in isolation, you'd say, I can't buy this company. It's quote unquote insanely expensive. What I didn't realize early on was that this growth phase exists. And at different periods in a company's life cycle, the management team is trying to optimize for different things. And one major mistake that I've made with valuation again and again and again is I used the wrong valuation metric at the wrong time, which of course leads me to make the wrong conclusion. It's very common, for example, for somebody to use the PE ratio when a company just reaches break even or isn't even optimized for margins. The analogy I make is that's like looking at a 7-year-old and saying, well, their SAT score is terrible, right? It's just too early for that number to be meaningful.
Yeah.
So one of the most useful things you can do with valuation is internalize the business growth cycle and learn which valuation metrics you should use at different times.
Brian, that is one of the most circumspect answers or discussions or perspectives I've heard about valuation. That's I think it's maybe even smarter than you think. I mean, there's so many people that just have one box or one, like a horse with blinders on. Say, I'm just going to use PE. I'm just going to use DCF. I mean, DCF in theory can apply to everything, I guess, but or some people value based on dividend.
I'll take issue with that for sure.
Ratio. Well, we can get back to that in a second, but the idea that and just in seeing your Twitter, your LinkedIn graphs, you're big on looking at life cycles, on looking at different times. There's a time dimension to investing that I think a lot of people miss, or even with the stock market, like how it's largely sentiment in the short term and then becomes much more about actual economics in the long term, right? I mean, that's a useful perspective, and I think a lot of people missed it. And the irony is you could search for very high PEs in the company. Those could be companies that are rapidly getting cheaper and just has a high PE because of that denominator effect. I love that perspective. So let me then go to the next question, which you just brought up. Someone like me might say, hey, discounted cash flow valuation analysis, where you actually get an Excel spreadsheet and you plot out the future revenues and profits and expenses, whatever, and then you discount them back to present value. That's robust enough to accommodate for, say 5 years of losses and then a break even and then profit after that. Why is it not?
Yeah, so like you, I have been classically trained, and I have heard the thing that the broad statement, which makes so much sense: a business is worth the present value of all of its future cash flows into perpetuity. And if you internalize, which makes complete logical sense to me, and if you internalize that, then a tool like a discounted cash flow model can, in theory, be used throughout that growth cycle to plot what a business is worth. I completely understand that from a theoretical level. There are several shortcomings to using a discounted cash flow model. Two that I want to call out. The first is a relatively obvious one, and it is intuitive. The discount rate that you use on that company dramatically dramatically impacts the valuation. We could have the exact same assumptions in our models about revenue growth, margins, free cash flow, debt structure, you name it. But if you use a 12% discount rate and I use a 10% discount rate, we're going to be in completely different universes.
It's the most important number by far. Yeah,
it is.
It's got too much power, honestly. Yeah.
So small changes in the assumed discount rate will have massive impacts on the present value of that company. So that's thing one. Of all the problems I have with discounted cash flow, that's actually a relatively small one. The biggest problem that I have with discounted cash flow models is they are inherently you're making a tremendous amount of assumptions about the future potential of that business. And if you've studied individual companies for any period of time, you know that trying to make future predictions about what's going to happen to any given company is an exercise in futility. One quick example that is way overused when it comes to valuation, but I think it's still useful. If you went back to the year 2000 and asked the most bullish analyst on Amazon, what is Amazon's revenue going to be in 20 years? And you went with the most bullish forecast. My guess would be that they underestimated Amazon's revenue by a factor of 10. At the very least. They could say, all right, 10 years from now, we think Amazon could do $20 billion in revenue. And the actual answer was, of course, in the hundreds of billions of dollars. And by their very nature, if you were to actually build a quote unquote correct discounted cash flow at that point in time, you would be the laughing stock of the room, because your assumptions would look so insanely optimistic that there's no way that the company could actually hit that target. So with discounted cash flows, you are making assumptions about long-term revenue growth, you're making assumptions about margins, you're making assumptions about capital allocation decisions, the return on invested capital, and the more assumptions that you put into the model, the more chances that you have of being wrong. In addition, with one major flaw that is rarely overlooked with discounted cash flow models is because of their precision, they actually lead naturally to a lot of overconfidence in the actual output that you get. If you put hours upon hours of your life into tweaking the exact numbers that go into discounted cash flow model, your confidence in that model increases dramatically, but your accuracy stays the same regardless of whether you spend 5 seconds on it or 15 days.
I love that answer, and yeah, I mean, it's a psychology. It's not so much the framework of the model. I mean, in theory, it sounds like you're saying it could work, but the problem is the practice. We're human beings, and we can't be precise enough to accurately use a DCF model. Let me just enhance the point you made about Amazon. I bet not only did those analysts underestimate Amazon's own revenue by a factor of 10, I bet they overestimated the revenue of a lot of Amazon competitors, maybe by a factor of 10 or 5 or 3 or 4. In other words, they tend to assume an average, and this is a problem with DCF. You tend to assume mean reversion, which often is too good for all the also-rans that end up failing and disappearing into the sunset, and is probably not good enough for the 1 or 2 or 3 big winners that often come to dominate industry.
You're completely correct. So to me, when a company is in that initial stage of growth, when it's in that money-losing phase, when it's in that product market fit stage, or when it's pre-profitability, a DCF tool, it has very little value. However, if a company is in the stable, mature, predictable phase, that's when I think DCF models actually have a lot of value. If you took a company that was a utility or a major predictable company like Microsoft or Google or Amazon or Nike, those are the kind of companies that are relatively predictable with their futures, and those are the kind of companies that I think DCF models actually have a lot of value on. So the earlier you are in the growth cycle, the less value I think there is in a DCF, but the later you on, the more value there is.
Very well articulated, Brian. I mean, when I ran a dividend newsletter for 10 years, I used a lot of DCFs, and there's a much less difference between the best utility and the worst utility compared to the best biotech and the worst biotech, in which case there's a huge difference. So the more mean reversion applies to your industry, I'd argue the more DCF is applicable.
Yeah, totally. And speaking of dividends, another very confusing valuation metric that people look at is dividend yield itself. Previously, if you are a dividend investor, which I know you are, one of the biggest mistakes that people make with dividend is the first screening tool they do is what?
Dividend yield.
Right. They want the highest possible dividend yield immediately to get the return on their investment. Makes complete sense. If you're after a dividend stock, you're after income, and you want, why not try and get the most income you can today? Again, going back to that business growth cycle, if you think about the phase that a dividend payer goes through, there's a time in a company's life when it decides, we have so much profits, we don't know what to do. We're going to start paying them back to shareholders. It's very common for companies that are just entering that phase to have minuscule dividend yields because they're only paying out a tiny portion of their profits to investors. And oftentimes those companies, because they're still relatively growing and they're trading at good valuations, have dividend yields well under 1%, which are numbers that repel a lot of dividend investors. Conversely, if a company is way on the other end of its growth cycle and it's in the permanent decline phase, its glory days are well over, those are companies that trade at low valuations, pay out a meaningful amount of their dividends to investors, and often have very high yields. So one mistake that I made when I was trying to invest in dividends is I was looking at the latter group. I wanted a 4%, 5%, 6%, 10% dividend yield, thinking, oh, I'll just buy that, hold it, and I'll make my money back in a period of time. And I completely ignored all the companies that traded at sub 1% dividend yields. Now, if I was investing in a dividend company today, I would actually do the exact opposite. I would be extremely focused on the companies that had low dividend yields that I think could grow over time, and I would avoid like the plague anything whose I thought best days were behind it.
And a lot of those dividend traps, by the way, the 10% yield companies or 13% yield companies, they're that way because of the math. The stock price is just cratered so much that the historical yield looks good in comparison. First of all, the stock price may go down more. Second of all, a lot of times that historical yield, that's last year's payout, by the way, it might not be maintained in the future. It may drop to half or a third or something like that. The dividend could be about to be cut. So in other words, there's a good chance you're chasing a mirage if you're chasing one of those big, huge yields.
Which I've done many, many times.
I've
learned the hard way. Low PE ratios and high dividend yields are more often warning signs than they are opportunity signs.
Brian, it is always a pleasure to talk to you. If someone is hearing this and says, you know what, this is not enough Brian Feroldi for me, I want more. I want more. Besides going to Amazon and getting this book, where else would you send them?
The best place to connect with me is just on my website, which is brianferoldi.com. We have a free weekly newsletter. We send out one email per week where we teach one investing or money lesson that we've learned a hard way, as well as we link to timeless content that can be read at any period of time related to a key money or investing lesson. If email isn't your thing, I'm also very active on Twitter, and that's just @BrianFeroldi.
Sounds great. Brian Feroldi, thank you so much for joining us today. And as always, thanks to you guys for watching us at home.
Always a pleasure chatting, James. Thanks for having me.